Let's bring in Savita Subramanian, BofA Securities head of U.S. equity and quantitative strategy. Savita, it's great to have you. So, look, we've had false starts before, I guess, on the value over growth trade. But what are the ingredients as you see them now for why this could last?
Yeah, I think we're in an environment. I mean, look, let's take stock of what just happened this week. We've got the two biggest economies in the world in stimulative mode. I don't think we should ignore that. We've got an environment where the Fed is cutting interest rates as the profit cycle is accelerating. This is unusual. As you know, the Fed is usually cutting into a slowing economy, a slowing profits environment. This time it's different. So I think those are the factors that we need to pay attention to. The market action this week, I think, is indicative of the idea that you don't want to avoid cyclicals in this type of environment. I also think the idea of the Fed cutting interest rates, it's not only liquidity inducing, but it's also cutting money market yields for this massive wash of money that moved into short duration bonds after the Fed started hiking. So I think that's the other area where we need to track flows and think about where these assets sitting in retiree accounts and money market funds are going. I think they're going into safe, stable income. That's more value than growth. So I would stick with value. I mean, we've really seen it start to work. We've seen earnings broaden out in tandem. I think it's kind of all cylinders are firing for a nice long value cycle.
So you've kind of named a bunch of the different attributes of what you think should work, right? So you have the income piece, dividend and dividend growth, probably will be a big part of future returns. There's value. There's also, don't be afraid of cyclicals. And then I think a quality bias. Where does all that come together in terms of, overlap, in terms of sectors, and can they all kind of feed into the same theme at once?
Yeah, it's interesting because some of these themes sound a little bit dissonant with one another. Where we're finding quality and value and income are in some sectors that you wouldn't necessarily think of as the quality income plays. So, for example, large cap real estate. S&P 500 real estate has de minimis exposure to office and much more exposure to power, grid, infrastructure, areas that are likely to see continued demand, continued spend. We're early in the starts on all of the data centers that tech companies need to power up all these chips they're buying. When you look at financials, I think financials in the large cap space is another higher quality sector than it was back in '08. These companies have basically been starved of capital. Energy, same story. These companies have basically righted themselves since, the last decade and are now throwing off free cash flow, focused on cash return. I think these are some of the areas of the market that you really want to press. I also think we're in an environment where you can get a little bit smaller. So, as you know, we like the equal-weighted S&P 500 over the cap-weighted benchmark. But I also think, mid-caps look really interesting here. And our SMID team, led by Joe Hall, have been writing about how mid-caps look particularly well-positioned to outperform in this type of environment. So, it's a little bit more risk-on than your typical easing cycle. But I do think, the areas that you want to focus on are materials. We just got China giving the all clear on materials, and this is a sector that's relatively underweight by professional money managers. Areas that have China exposure that are just starting to rally. I think there's a longer themed story there. So, these are the areas that I would watch in the next 12 months.